Jayesh, thanks so much for being with us on NDTV Profit. Let's first start with the macroeconomic data point that came out today earlier. CPI inflation has come at the lowest in the new series at 3.17%. But the worry about the core inflation remains. That has strengthened. So do you think now, the best is behind when it comes to bond yields and they will only harden from here on? Because when you look at the longer end of the curve, that still hasn't moved much.
No, I think longer end would stay supported because if you are targeting 4% inflation, that definitely should get stay supported. Of course, you will have technical sell-off coming in. You will have new supply coming in starting April. So that will get affected. I think the biggest challenge is, yes, your headline inflation, and the target is headline inflation for under the MPC committee. And so certainly we are seeing, core being looked at. Yes, it does matter, but I think we will come to know only in next 3 to 4 months where exactly if either the headline really goes sub 3 or core starts softening a little bit, because till that time it's going to be very difficult. And I think yesterday when the numbers came, market was, people were feeling very optimistic about the thing that it's so soft inflation. But if you really look at it, RBI has really preempted February, March inflation by saying that it will be low, but we are more looking at second half 2018. Maybe that's where their estimate is 4.5%. Now, unless you see, April, May inflation really softer than their estimates, that's when the market will start looking at other things.
Right. But to your mind, what factors could drive inflation really soft in April, May? Because, the reason why CPI has crumbled is because of what's happening to food inflation. Vegetable prices have fallen. Even I noticed papaya prices in Delhi coming down to 36 rupees a kilo. I don't remember papaya prices being less than 40 rupees a kilo for the last 4-5 years. But, this is because a lot of people believe there's been distress selling for vegetable prices. This could ease. And when it comes to producer prices, we import a lot of inflation. In China, producer prices have come at a 6-year high. So on both sides, it doesn't look like the RBI will have a lot of comfort when it comes to inflation.
Yeah, that's a futuristic view as of right now. Of course, on food, we had, 2 droughts and then a good monsoon. That really helped. Plus, of course, I think on demonetization, the demand for perishables, the price has to adjust. As far as non-perishable, the demand can get pushed out and then it can get consumed later. But demand for perishable and semi-perishable. So we actually will have to see whether, of course, this looks like the bottom. If you look at core food inflation was just 0.53%. This looks like bottom, but we'll have to see in April, May, even if it is at 1%. And again, we will have to look at the headline and the core. Core, of course, went higher. RBI in their policy was talking about 4.9 sticky. We had 5.10 core inflation. So that is a little bit of concern. But again, I think the world, if you really look at it, the policy statement which RBI did, I think that's in current world is perfectly justified. Like there's so much of uncertainty happening globally, right? Basically driven out of US, their tax laws, their policies, and there is a completely wide varied viewpoints. There are more of the researchers talking about 3% plus US 10-year yield. People are talking about inflation in US coming very soon. Now, whether that happens or not, only time will tell. But as of right now, that's where the view is. And therefore, the stance from accommodative to neutral, because then you need to be open on both sides of the situation on the rate movements. So I think that policy document per se was perfectly fine. But I think but the narratives there, and then the post press conference, and then the forward looking inflation at 4.5, that's again it's only time will tell. I think it doesn't look like going there, but hopefully this is our just a feeling that your headline still will remain softer in April, May, and if that remains, then maybe that projection of 4.5 might change later on. But yes, you can't really expect a cut in April, and with supply starting in April, every week 15,000 crores. To expect bond to rally immediately, it's something not really feasible. Of course, some short-term bips of 5 basis points or so, that's different, but really coming down dramatically doesn't look like.
What about the currency? Post the RBI policy, the rupee has gone beyond 67 to a dollar, staying below that. What do you make of the currency moves now? If the expectation is that we may not see more rate cuts coming in soon, and the differential with the US rates is not going to narrow in a hurry, do you think inflows could stabilize? Where do you see the currency headed?
So I think if you look at a pure macro for India, I think we have the best macro going in last few or maybe last 20-30 years for as far as India is concerned. I think we have global headwinds which is negative. So if you really look at it, maybe yes, it is sustaining right now, but it is getting prepared. Like if you really see dollar strengthening happening, do you think our currency will sustain? Maybe it will not get hurt like other emerging market, but it will get impacted. So I think that's where the situation is. Of course, it's only after a few days the dollar has strengthened a little bit, but actually from the peak, it has really kind of softened against all currencies, and it will actually follow the dollar trend rather than anything else locally.
Mr. Mehta, what do you think currency and bond markets would do if there is any uncertain outcome from US? You think that is the biggest risk as far as flows into India are concerned, not only for debt but even for equities?
Yeah, I think that's the biggest risk. Now, whether that materializes or not, that's a different story. But if it materializes, if the US yield goes up dramatically, and on what basis? It's like US growth going up, then maybe initial shock will be there in all emerging market, including India. But your equity will, come back much faster than other emerging market if that happens. But yes, in the initial reaction when the yield goes up, globally, I think that becomes more attractive for the investors community, and therefore the flows, whether fixed income or equity, both from emerging market would move to the US market, because on an absolute return basis, you will be still better off in US if it crosses 3% plus. But it doesn't look like immediately.
One of the key arguments for buying India was rates coming down in the system and equities becoming cheaper, plus the safety on the bond side. You think that is now behind? So incremental flows will have to come in from performance of the corporate side in terms of better results, in terms of better numbers coming on the Indian balance sheet side. You think that that's what will attract now new flows?
Yeah, I think at least on the debt side I can talk about. See, on the equity side, of course, overall still India is the fastest growing country. So to that extent, that flows will come, barring the technicality. In the fixed income side, you have two types of investor, which is one is long-term diversification of the portfolio. They would continue to come, but then they are very small in terms of percentage. A lot of investors are more about making capital gains either on currency, a coupon plus capital gains on currency, or capital gains on the bond itself. Now that story for the time being, it's off the table. Maybe they would wait for a target of maybe 7% or so. So maybe at that point of time, again, we might see some flow. But of course, this is subject to how US pans out in next two months.
Right. If the rates don't come down from here on, and the way we have seen the 10-year yield getting slightly higher in terms of rate, you think banking loan growth could pick up? Because that is something which has clearly shifted market share towards bond. You think that will now start changing? A little bit of market share would be gained by them as well?
Loan growth, of course, it's a question of demand. We don't really see new private capex coming in. I think loan growth was... I think bond market was never, or GSEC market was never a problem. If there is a good bankable project, getting money for them was never a problem. It's only, when it is little bit stretch or stress, that's where the problem is. So I think if there are private sector, good companies start borrowing, the money will be available. I think we have enough liquidity in the system. bank would be more than happy to lend to the borrowers.
Right. As far as flows is concerned, and especially for the debt side of the market, which you track very closely, the last 2 years have been phenomenal, at least after 2013, once we had that shock. After that, flows have been phenomenal. Do you expect 2017 to see similar flows?
Not that dramatically, but yes, it's just a question of momentum. So as I said, like 7% or maybe a 680, 685, 7% Indian bond. Does it look good? Yes, it does look good. Of course, you will have supply factor coming in April. That way, bump up a yield little bit. But right now, as I said, the headwinds from the global side, if your bond yields are going to, that's the expectation now, that if US 10-year goes to 3%, people think that, okay, it may not sustain at 3%, and therefore there is capital gains to be made there in US bond, buying at 3% and then maybe selling at 260, 250 or 240. So I think that's where the flows would move in the immediate thing. But I do expect that once we stabilize this, once we see the impact of the continuous flow, which will be in the first half, 17-18, of the supply, and how that is managed, I think people will start again coming for capital gains. I still am quite optimistic long term. If we are going to 4% inflation target of January or February, March 2018, there is no reason your bond yield has to be 7% plus in that situation.
Just the point that you made again, even at 7%, India, with the dynamics that it has, the visibility that it has over the next few years, you think it's still pretty attractive? And say 10 basis, 20 basis point here and there is no reason for flows to slow down or at least redemption to come in?
No, absolutely. See, I think purely from a carry perspective, whether it's 687 or 720 is more or less the same, that looks quite attractive as a rate. The question is, when people look at a trading gains perspective, they are looking at, when they see the directional movement coming in. So in that situation, the absolute number does not really matter unless it goes so dramatically high that, okay, it cannot go up further anymore. But otherwise, they are looking at your 20, 30 basis point, capital gains on the bond side. So that segment is different. But as I said in the beginning, foreign investors, particularly who are looking at long-term diversification, as a number and percentage is very small at this juncture for diversification. If we have maybe 5, 6 more of them, then it's a different story. They would continuously keep on coming every month as a long-term diversification at this yields.
Mr. Mehta, thank you so much for taking out time for us. Always good to get a perspective. That was a view coming in from Bank of America Country Treasurer Jayesh Mehta.